All right, today we're going to talk about a financial tool that's, well, it's powerful, but it can also be pretty dangerous margin. But we are not talking about YOLOing into meme stocks. Nope. We're diving deep into a real world case study, one team's personal experience using margin for just one thing cranking up the income on their existing investments. This is a bit of an advanced strategy, so let's get something straight right from the top.
Okay, here's the super important disclaimer. What you're about to see is for educational and entertainment purposes, period. This is not financial advice, it's not tax advice, it's not investment advice. We're looking at a high-risk strategy, and this is absolutely not a recommendation for you to go out and do this.
You've got to do your own research, talk to your own licensed professionals. And any ETFs we mention, they're just examples to show you how the math works. They are not sponsors, we're not endorsing them. Okay, now that this serious but necessary part is out of the way, let's get into the core idea. So here's the big question, right? The one that probably brought you here. How can you squeeze more income out of your portfolio without having to constantly find and add more of your own hard-earned cash? How do you make the money you already have work even harder for you? And that is precisely what we're going to unpack today. We're going to walk you through this team's personal blueprint for using margin to boost their income stream, looking at their philosophy, their really strict rules, and some actual examples. So let's start with the tool itself, margin. But let's frame it in a very particular way. We're not thinking about it as a speculative lottery ticket. We're thinking of it as an income amplifier. It's about using a specialized tool for one specific job. So just a quick refresher so we're all on the same page. Margin investing is pretty simple. In theory, you're just borrowing money from your broker and you use your current investments as collateral. That loan lets you buy more stuff, hopefully amplifying your returns, or in this specific case, your income. Now, I absolutely love the way this team thinks about it, and it's the perfect analogy. They say, think of margin as a hammer. It can build a house, but it can also be used to destroy it. I mean, that just says it all, doesn't it? Used with skill and discipline, it can build something amazing, but if you're reckless, you can do some serious, serious damage. So, if margin is a hammer, how do you keep from smashing your own thumb? Well, you have very strict rules, and the absolute bedrock of this team's strategy is their 10 to 20% rule. The vast majority of their portfolio, we're talking 80 to 90%, is never ever touched by margin. They only use this powerful tool on a small, totally manageable slice. That's rule number one for keeping the risk in check. Okay, now let's see how that rule fits into their whole plan. This is their blueprint in action, the pillars that they follow to use margin strictly for income. Their whole approach really comes down to 4 pillars of discipline. First, like we just saw, only use that small 10 to 20% slice. Second, and this is so important, only invest in ETFs that you know inside and out, that you already have conviction in. This is not the time to be experimenting. Third, the math has to make sense. The yield you get has to be bigger than the interest rate you pay on the loan. Simple as that. And fourth, absolutely no crazy volatile stocks or crypto. This is all about stability and conviction, not trying to get rich overnight. So if they're not buying anything volatile, what are they buying with that borrowed money? They focus on very specific tools for this job. We're talking high-yield covered call ETFs and something called business development companies, or BDCs. So why these specific ETFs? It all comes back to the goal: income. Covered call ETFs are literally designed to generate regular cash flow, and BDCs are basically funds that loan money out to businesses, and they are legally required to distribute most of their income as dividends. So both are built for high payouts, and because they're diversified ETFs, they tend to be a lot less jumpy than a single company stock, which is exactly what you want when you're using leverage. Okay, let's make this real. Here's an example of how the math works. Let's say with a broker like Interactive Brokers, they invest in an ETF like HDIV, which is kicking off a 10% yield. The interest rate on their margin loan is 5%. The math here is super simple. 10% coming in minus the 5% going out to the broker leaves you with a 5% positive net return on money that wasn't even yours to begin with. It's all about capturing that spread. And just to show you this isn't a one-trick pony, here's another example. With a different broker, maybe Questrade, the margin rate is higher, say around 9%. Well, that means you need an ETF with a bigger yield to make it worthwhile. So in this case, something like Bank with a yield of around 15%. Even with that higher borrowing cost, 15% minus 9%, you're still looking at a healthy 6 to 7% net return. Same principle, different numbers. Okay, we've seen how the hammer can build. Now we have to talk about how it can destroy. It is time to look at the other edge of this tool, the risks. And trust me, they are very, very real. Risk number one, the one everyone's heard of, the dreaded margin call. This is a demand from your broker. If your portfolio value drops too much, they call you up and say you either need to deposit more cash right now or they are going to start selling your investments to cover their loan. And guess what? They'll be selling at the absolute worst possible time, locking in your losses permanently. The second risk is just brutal math. Just like margin juices up your income and your gains, it does the exact same thing to your losses. A 10% drop in your investment isn't just a 10% loss on the borrowed money. It's a massive hit to your own capital. Leverage is a two-way street, and the ride down is a whole lot faster. And finally, the one risk that is an absolute 100% guarantee, the interest costs. This isn't a maybe, it's a certainty. Every single day, you are paying interest on that loan. It's a constant drag that your investment has to overcome. If the yield on your ETF ever dips below your margin rate, you are guaranteed to be losing money. So when you boil it all down, this is the trade-off. It's crystal clear. On one side, you've got the potential for more income and better cash flow, but on the other side, you have the very real peril of bigger losses, the threat of a margin call, and that guaranteed cost of interest. You have to constantly weigh that balance. So we've walked through the mechanics, the examples, and the very serious risks. But now we've come to it. The single most important message in this entire case study. If you take away only one thing, this is it. This is the lesson you need to print in your brain. So after seeing all that, the good, the bad, and the ugly, what is that one lesson you need to remember above all else? This is the core of this team's experience, the golden rule that keeps that hammer from destroying the house. And here it is, the golden rule. Do not get greedy. Don't push the envelope and get anywhere close to a margin call, and most importantly, do not buy anything new on margin. Just extend your investment, don't reinvent it. Think about that. This is the whole key. They only use margin to buy more of the stable income-producing ETFs they already own and believe in. They aren't gambling on a new hot tip. They are simply amplifying a strategy that's already working for them. That, right there, is the most critical lesson to take away from this. Look, this case study is just one piece of the puzzle, one strategy on the long road to financial freedom. If you're passionate about things like financial independence, generating passive income, maybe even retiring early or living a nomadic lifestyle, then you're definitely in the right place. And hey, if you got any value out of this breakdown, it would mean the world to us if you'd hit that like button and subscribe for more content. We're always exploring different strategies for financial independence and sharing updates on our own journey to help you with yours. And finally, we want to hear from you. What's your favorite income strategy? Are you all about dividend stocks? Are you into real estate? Or are you doing something completely different? Drop a comment below and let's get a conversation going. Thanks so much for watching, and we'll see you in the next one.